Hi guys, I'm AP. In this video, we are going to see the fourth chapter in the book The Intelligent Investor. The fourth chapter is the general portfolio policy of the defensive investor. Let's get started. Okay, this chapter is all about introduction to the defensive investor and how a defensive investor portfolio should look. According to Graham, a defensive investor who always expect a lower return as long as he want a safety in his investment, and he should be happy with whatever return he is getting from the market. Okay, now Graham states the difference between the defensive and the enterprising investor. Okay, an enterprising investor is who spends a lot of energy and time to his portfolio. Whoever spending a lot of energy and time looking in his portfolio, who is called an aggressive investor or an enterprising investor. And defensive investor is who not spend so much of time and energy looking in his portfolio. Okay. Also, Graham advises that ones who have no time and energy to spend in the market, who should always select the defensive investor portfolio policy so that he could be don't worry about the daily market fluctuations. Okay, now the Graham says is the simple way of following the defensive investor portfolio is having a 50% of bond and a 50% stock portfolio. And whenever we are getting a higher returns in a stock market or whenever the stock market is high, we should always consider booking profit and move the profit amount into the safest instrument called bonds. Also, Graham says that it is the toughest thing to do by booking profits and moving to our bonds. It is always one should consider having a balanced portfolio between bond and equity. And Graham also says that the defensive investor should not have a 100% equity portfolio or a 100% bond portfolio. It should be in a combination one, at least 25% of bond or at least 25% of equity portfolio. Okay. Now let us see how to select a bond. We should always see whether it's a taxable bond or a tax-free bond, or whether we are investing in the bond directly or we are investing through the debt funds. Okay, investing in tax-free bond is good for a long term, but we should consider that the return is relatively low even if we compare with some small bank FDs, but it always has the same risk as the tax bonds. Okay, now let us see the types of bonds. There are two types of bond, one issued by government and by the corporate bonds. In government bond itself, it's also two types, one issued by RBI and another issued by the public sector companies. That is nothing but if a government has a 51% or above stake in a company, it is called a public sector company bonds and the corporate bonds. Okay, if we compare the returns of the government bonds with the corporate bonds, the government bonds will always have a lower return compared with the corporate bonds because the government bonds has a very less chance of the default risk, and for corporate the default risk is so high so that the yield also so high. Okay, now let us discuss how to select the maturity of the bond. The maturity period of the bond has from almost 1 year to 20-30 years. Graham always advises a defensive investor portfolio should have a short-term maturity bond and a long-term maturity bond. The short-term maturity bond is expiring between 3 to 4 years from the date of we are buying, and the long-term maturity bond is around 10 years of maturity. Okay, the Graham advises one should not have a maturing period over than 10 years in his bond portfolio. Okay, now let us see the pricing of the bond. Now let us consider the interest rate is so high and we buy a bond and lock it in a higher interest rate. If the interest rate falls, then our bond value rises and vice versa. Now let us consider if the interest rate is too low and we buy the bond and lock it with the lower interest. If the interest rate rises, then our bond value falls. Okay, now let us see the commentary written by Jason Zweig to this chapter. Okay, the Jason Zweig says that there are two types of intelligent investors. The first one is who continuously researching, selecting, and monitoring a dynamic mix of bonds, stocks, and mutual funds in his portfolio. And the second one is who buys a permanent portfolio and runs it in an autopilot mode, and he will further put no effort in this portfolio. This is what Graham says the difference between the enterprising investor and a defensive investor. An enterprising investor is who continuously looking for an opportunity and a change in his asset allocation in his portfolio. But the defensive investor is who never worry about the volatility in the market. He will always tend to invest in the common stock portfolio which he has, and he will accumulate the stocks over a period of time to generate wealth for him. Okay. Now let us see the second point mentioned by Jason Zweig. Jason Zweig said that Why not 100% stock portfolio? Okay, Jason Zweig said there are some exceptions that one can have a 100% stock portfolio. The exceptions are one who has enough cash to support his family for next 1 year. And the second one is one should always know to how to survive in the bear market, like happened in 2000. And the third one is one should always accumulatively buy a stock even though it is a bear market. And third one is one should know to how to invest continuously even over a 20 period of time. These are the points, the exceptions set by the Jason Sake to have a 100% stock portfolio. Okay, now let us see the third point mentioned by him. The third point is there is a confusion between everyone that how much percentage we should have in bonds and how much percentage we should have in stocks. The thumb rule for this is everyone says we should minus our age from 100 and what percentage we are getting, that percentage we should have in bond. Let me give a quick example. Let us consider my age is 30. Then if I subtract it from 100, then the remaining is 70. The 70 percentage I can have in a stock portfolio and remaining 30 I can have in the bond portfolio. But Jason Fig and Graham says these are the stupid thing to do. It is all about our financial situation, have our portfolio in a bond and stocks. Jason Fig even mentioned two stories in here. The two stories are now let us consider the first one. He is a grandma. His age is 90. It means that he should have 90% in bond portfolio and 10% in stock portfolio. But it makes no sense having a 90% bond portfolio at the age of 90 because if the grandma has a grandchildren for their future, he can invest in the stock market so that when they are getting old, they could have a very good amount of money. And the second situation is consider a 25-year-old boy and he is saving up for upcoming future expenses. And if he put 25% of money in bond and 70% of money in stock market, then for his needy in the future, he cannot take up from the market with a higher returns possible. Jason Swick said that there is no thumb rule for investing in bonds and stocks. It is always our financial situations. Okay, let me conclude this chapter by saying that one who has a defensive investor portfolio has a peace of mind and a adequate return over a period of time. I also suggest everyone to have a defensive investor portfolio. Okay, in upcoming chapter, we are going to see the defensive investor and the common stock and how to select a stock for his portfolio. So that's it for the video. Thank you for watching. Stay tuned.